Welcome, welcome, welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn with Focus Compounding, on air live with Geoff Gannon. Geoff, how goes it today?
It goes very well, Andrew. How goes it with you?
It goes very well as well. We hope it goes very well for everybody else. If this is the first time you are tuning in with us, thank you so much for joining us. Be sure to check out all of our content that we push out into the investing universe. If you've been listening for some time, you know this. The best way to do that is to follow me on Twitter at @FocusCompound. Of course, hit the subscribe button wherever you're listening or watching us. And if you're interested in learning about our money management services, you can reach out to me at andrew@focusedcompounding.com. Of course, all the information is in the description below. So today is December 21st, 2023. This will be the last podcast that we will record that will be uploaded in 2023. So we are going to be doing a reflection podcast as we did last year on the year 2023. And if you can remember, Geoff, we did do a segment on predictions for 2023.
Did you write them down?
A little, I did, yes.
Okay.
I will say
Right.
you sounded a lot better than I sounded, right? That was kind of trolling around, having fun with it, but I did feel what I said, and we're going to talk about that.
Did I say the NASDAQ will be up 40% or whatever?
You did not say that. However, you were pretty, you kind of hedged a little bit, I will say. You were much more, it could happen, right?
Yeah, I didn't listen again. My guess would be I said it's unusual for the stock market to be down big 2 years in a row. And so that's the only cautiously not too bearish thing I probably said.
Yeah, I mean, look, this is what you had said. The main thing you had said was we could look back and say, stocks bottom and the Fed ultimately pivoted. But your main message was you're not seeing things that are like super overvalued anymore, right?
Okay.
So you were saying that you're seeing more things that are like interestingly valued than overvalued. I had said, and I kind of joked that this was the famous last words, that value would come back, and that eventually if the Fed pivots and lowers interest rates, that the biggest losers will be retail investors because all these high flyers where you're partying with zero interest rates and whatever aren't going to come back into rotation. And obviously that was incredibly wrong because the past couple of months you've seen a lot of these high flyers start to take off again. So, that's kind of what I said. But you had said that there are some things that seem cheap to you. I mean, you even named a few different stocks. Vera Bradley was one that you had thought looked pretty cheap, irrespective of what happens in the market. It's up 61%, not bad.
That's not bad. The business hasn't gone well, but it improved, because people figured there won't be a recession, whereas when we recorded last time, they were sure there was about to be a recession.
Yeah, you called out Green Brick Partners, saying that you thought it was pretty good value. You didn't think it was overvalued. You thought that could be an interesting thing to look at. It's up over 109%, not bad.
Oh, this isn't good for our clients to listen to because we don't own Green Brick and Vera Bradley.
We don't.
Stocks I throw out. Yeah,
I've told you. I think actually Geoff could be a. What do you want to call it? Like a intelligent speculator. I mean, Buffett in his personal account, he's always doing these different things that he wouldn't do for Berkshire. But every now and then you bring up stuff on the pod where you're like, yeah, it could work out. And it does work out.
Those are just very cheap. At the time, they're very cheap stocks with a lot of pessimism, but they're total macro things of why they were cheap. Yeah.
Yeah. I mean, it kind of reminds me of you were talking about before where you were doing like a related hedge for Value Investors Club. You didn't invest in it yourself, but you had thought it's something that Value Investors Club would be interested in, just their style of investing. And you did not get approved, but it was up like, I don't know, many multiples from it worked out just like exactly how you thought it would work out.
I thought it was a good idea. Short something that had ethanol in the name that everyone was speculating on and go long something that was ethanol, but it wasn't called ethanol yet. And it worked out well because the long even has done well, but the short went to zero. So,
yeah. I mean, I remember we looked at that like 3 years ago or 4 years ago and it worked out perfectly well. So we could talk about 2023 a little bit. We can reflect on it. As of December 15th, JP Morgan, they did most of the work for us. They took all the big events that happened in 2023, and I thought we could speak about it. Let's see right here. Their top takeaways says stocks and bonds have soared this week after the Federal Reserve signaled rate hikes are over and cuts are coming. Heading into Friday, the S&P 500 is less than 2% away from its all-time high, last seen in January 2022. And the rally is broadening out from just big tech, and 10-year Treasury yields closed back below 4% for the first time since July. And they did a comparison of this time compared to last year. Last year, U.S. equities were down 18%. This year, we're up 24.5%. World equities down 17.7%. This year, 21.6%. Performance of the 60-40 portfolio, U.S. high yield, cash, commodities, etc. So big difference on what a year can make. So to your point about it's very rare to have two large down years, obviously that worked out well. Talked a little bit about the Fed being done hiking, and it looks like interest rate cuts are next. We're currently at 5.25 to 5.5. But if you look at the Treasury yield curve, as we spoke about recently, they're projecting interest rate cuts. So we'll see what happens. I mean, this is looking like a soft landing, Geoff. I mean, we'll see what happens, right? If they over tighten, but so far.
They say about the predicting 9 of the last 5 recessions or whatever. Well, I think soft landings is they've predicted 11 of the last 1 soft landings or something. It's pretty, the record's pretty bad. Everyone always thinks there's going to be a soft landing. I mean, 2008, they thought there'd be a soft landing. I mean, I always cite the New York Times article after the Archduke Franz Ferdinand was assassinated that said at the end of the article, and experts say this might be good for peace. World War I started just after that. So,
yikes.
Yeah.
Yikes. They said markets are moving quickly, but we don't think you've missed it. And then it hits on why they believe that. Inflation will likely settle. Price pressures are abating, and the Fed's own forecasts show a durable path toward its 2% inflation target. Do you agree with that?
Yes, I agree with that in exactly the way that they put it. We could get into specifics about that later, but yes, all those things are true.
But how much is inflation still up compared to 2022? I mean, that's just a year over year thing.
Correct. And there's very little in the core things that matter to the Fed about the services stuff and all that. I've talked about sticky price inflation. Depending on how you measure it, sticky prices, whether we're talking about 1 month, 3 month, a year, we're at 3.5 to 4.3% or something. They're all cyclical things that have collapsed, right? So it's a benefit from things that are cyclical because the economy is not so great, which you can see if you ask people, how's the economy? They think it's terrible, households and stuff. So they feel that. But that's how interest rates work. We talked about that. Interest rates don't mean that people are going to buy fewer pizzas and get fewer haircuts and stuff. It means that they're going to buy fewer cars and houses and not build out a deck and not buy, grills and not put in swimming pools and all that kind of stuff. That's what the Fed can really affect, and in fact, affect in a really big way fast, and they have.
Mm-hmm. Where I've noticed it the most in my personal life is just at the grocery store.
Mm-hmm.
I'm constantly shocked by how expensive some things are at the grocery store. And I'm not even shopping at Whole Foods. I mean, where I live, there's a neighborhood Walmart, and even syrup or sriracha, $16, $17, something crazy like that. Yeah, absolutely crazy.
Well, we're talking about rates, not price levels. Like I said, since before COVID, depending on what thing you're talking about, price levels will be up 20 or 30% permanently. You just have to get used to that. They'll never go back down. So that's why old people talk like that and say it's outrageous that something costs, $5 or something, because they remember a time when that was the very high priced one. That was the best thing there is. And now the worst one costs that, because you never get back purchasing power once you lose it. There's almost, in the modern era, in the 1800s you did, but in the modern era, you don't have meaningful periods of deflation ever. So it never goes back the other way.
Next, the cash conundrum. With the Fed and other central banks now on the verge of cutting, and potentially sooner rather than later, once juicy yields on cash stand to fall, and fast. Any thoughts on that?
That's what the market's predicting, and it's even in the Fed's dot plot now.
Mm-hmm. Bonds are more competitive. This also means that now looks like the time to consider locking in still elevated bond yields. The opportunity cost against cash looks even greater after this week's central bank meetings, especially if we end up seeing more cuts than we expect.
No, I think that's a terrible idea. I would not do that. There's just high risks to doing that, and you're getting a yield on the bond. I mean, it's inverted. You're getting a yield on the bonds that are lower than you would in short-term stuff, and you're taking the risk that something doesn't work out the way you expected longer term. So I don't think that's a smart idea.
So what would you do instead of that?
I think you should hold cash instead of going longer term like that.
Mm-hmm.
The rates they're talking about are like on the risk-free rates 3 to 4% and stuff, and then so I don't think that's a great idea. But
the stocks will likely march to new highs. A soft landing marked by moderate inflation, solid growth, and easier policy spells for a sweet spot for stocks. If the data continues to turn out even better than we expect, valuations could have some more room to expand, and earnings could even grow a bit above the trend-like pace we expect in our base case.
I guess that's possible. I'm not sure, to be honest.
Mm-hmm.
This is different from when we talked last year. Now they're pricing in a soft landing and saying if things come in even better than we expect. So I don't know. That's difficult. I just say it would be unprecedented. So it's not that it can't happen based on the numbers, but you're betting on an unprecedentedly pleasant outcome. So it might feel like it for a year or something, but it depends on exactly when you set the time periods for the cutoffs. So it'd be the best outcome that there's ever been historically if that it's achieved.
Mm-hmm. And then the last one, contain credit stress. Avoiding a recession means that credit stress should be more limited to areas such as commercial real estate and select pockets of corporate debt. Nimble, experienced active managers could take advantage.
Yeah, I disagree with that one entirely. I think there's strong signs that credit stress will be worse than historically experienced, given the same economic outcomes. We're already seeing that. Carmart has the highest charge-offs that they've had like ever, and there's unemployment at like nothing. Their model wouldn't allow for that being a possibility. I just think that there's corporate things in the leveraged loans and stuff like that that are at risk. That one is probably
bankruptcies are up.
Yeah, they're just totally abnormal for this kind of economic environment. I know that the overall GDP and inflation things people are feeling good about, but when you ask households, when you look at bankruptcies, when you look at certain charge-offs in certain areas, they're extremely, extremely high for this sort of economic environment. So like trying to explain to people, oh, it's not really that bad. The macro data says this. Well, you wouldn't be charging things off and stuff if the macro data is reflecting the underlying situation. There's something else going on that's unpleasant for people and companies in terms of how tight they are, how close they are to the extent of what they can handle. So, yeah. I expect that adjusted for whatever economic outcome we have, credit losses will be worse. So if we don't have a recession, I think you could see credit losses that look halfway between a recession and not a recession. If we have a recession, that's kind of mild. The credit losses could look more like a deeper recession, that kind of thing.
They say looking at soft landings even more broadly, the S&P 500 typically rallies by roughly 15% on average in the 12 months after the first cut, going back to 1965. And they have a chart right there.
Okay.
Something that was interesting was the major events that happened throughout the year. China ends its zero COVID policy. The U.S. government hits its legal $31.4 trillion debt limit. Balloon Gate, which I was thinking, I was like, Balloon Gate?
Oh, yeah.
Is that when the Chinese balloon thing was floating over in America? I was like, gosh, that feels like it was so long ago. Kansas Chiefs win the Super Bowl. Kansas City Chiefs win the Super Bowl. Silvergate Bank voluntarily liquidates. Was that voluntarily, do you think?
Yes, that was interesting because I saw something where some people said, "Oh, this is really good," because people had talked about like how bad all this crypto stuff was and whatever, and they're doing the right thing. That they're doing this before they would have to shut down the bank and everything. So yeah, technically that is true. Yeah.
Silicon Valley Bank fails. And U.S. banks post their worst daily performance since 2020. Are you surprised that it was really contained to Silvergate, Silicon Valley Bank, First Republic? I mean, at least so far.
Yeah, I mean, the stocks don't look that great. If you've been invested in bank stocks, you know that the multiples they're at and stuff are not good versus what they were like before. And there's hasn't been total containment of like the effect it's had on earnings and stuff. But yes, they had a lot of capital and they had a lot of excess deposits. So we always said that, people always said that look, the banking system is not the part of the economy that's most at risk. Same as like when we talked about 2008. The households are not. Unlike 2008, households and banks are not the things that are in trouble. Governments and businesses are the things that are much more at risk of feeling, pain in terms of credit stuff.
Mm-hmm. Let's see. Xi Jinping reelected as president of China for an unprecedented third term. OpenAI launches GPT-4. Taylor Swift kicks off her record-breaking Eras tour. Do you think that was a success? You're involved in media. Yeah.
You mean
consider it a big success? Do you think it was a letdown? What?
The tour was a big success. The putting it out on in theaters is what we talked about, right?
Yeah,
I think we got pretty close. I don't know if it ended up around 200 million, but we said, I said it would be amazing if it tops 200 million, even though everyone was saying it would. It opened.
Yeah,
to
I think you were spot on with that.
Yeah. But we have data, so it's people get hyped up, but you can go back and look at decades of data and see, oh, Michael Jackson only did this much. I don't know that Taylor Swift's gonna double that or something.
Yeah, you were spot on with that. UBS buys Credit Suisse in a government-backed deal. Forgot about that. What a crazy year, huh? I mean, it's almost crazy in the sense of how, I hate to say it, but contained all of this stuff actually has been. And it hasn't set off on like this global, depression or whatever. LVMH becomes first European company to reach 500 billion market value. Okay. Congratulations. JP Morgan Chase takes over First Republic. Let's see. WHO ends COVID-19 declaration of a global health emergency. A coronation of Charles III and his wife Camilla as King and Queen of the United Kingdom. NVIDIA blockbuster earnings report kicks off AI hype in earnest. That's true. U.S. government suspends the debt ceiling. Goodness. New York City covered in orange smoke from Canada wildfires.
Oh, yeah.
I mean, that was not just New York City, though. I mean, that was even Illinois. I mean, that was all throughout the country. That was not good. S&P 500 marks 20% rally from its October 2022 lows. The U.S. May CPI report officially marks a halving in inflation. Well, okay. The Federal Reserve pauses its most aggressive rate hikes in decades. The Titan submersible implosion. That was very sad. Hottest global temperature ever recorded. Okay. The widely anticipated Barbieheimer weekend kicks off. Did you see Barbie?
I saw Barbie. I did not see Oppenheimer, unfortunately.
Okay, so I saw Oppenheimer and I saw Barbie. What did you think of Barbie?
I can see why it was the biggest movie of the year.
Yeah.
It had things going for it that if it had been made more as a standard movie, it wouldn't have been the same cultural experience. But I do have to say, there were a lot of kids in the audience, and there is a point where there's some speechifying and stuff where the kids were kind of like, Mommy, why are they just talking? Why don't we, and running around the aisles and stuff? But it was made for everybody. So, it was worked well that way.
The Federal Reserve hikes interest rates for the final time in 2023. Fitch, here's something that didn't get too much chatter. Fitch downgrades credit rating for the U.S. government from AAA to AA+. What did you think about that?
I mean, the U.S. is not AAA credit anymore. That's not news. So,
yeah, not surprising.
Yeah.
Wildfires ignite on the Hawaiian island of Maui.
Yeah.
Haven't heard too much about that recently, other than when it was happening. U.S. CPI inflation reaccelerates for the first time in over a year. Chip designer ARM's IPO soared nearly 25% in market debut, marking the largest IPO of the year. Didn't get too many IPOs, though, in 2023.
No, kind of started up at the end part here, and it's been mostly the very hottest of like tech stuff, I think, has been the ones that have gotten the most attention, right? Like if you're AI or something, you could definitely go public.
Mhm.
Yeah.
Uh, Crude oil prices rally almost 20% in a month to peak at $97 a barrel. McCarthy ousted as House Speaker. Okay, we don't care about that. A 10-year U.S. Treasury yield hits 5%. In intraday trading for the first time since 2007. FTX founder Sam Bankman-Fried convicted of one of the largest financial frauds on record.
Yep.
And obviously, we both read the book Going Infinite.
Yep.
Eli Lilly weight loss drug obtains approval in the US and UK. Is that with the Ozempic or Mounjaro?
Yeah, Wegovy, Ozempic, Mounjaro. Yeah, all that's actually huge news. We haven't talked about in the podcast, but there's even been stocks in junk food things and stuff that have been down because people say those things should be down and the stock thing should be up. I've gotten a few emails from people, especially in more than one from people in Denmark, because I think that Novo is a very hot stock, worldwide, and so it's kind of when we talk about things that are very expensive, we're not. When I say like there's not as much insanity last year, there is some in like some of these drug things and in AI and generative AI or whatever, and in semiconductor stuff related to that. Those have kind of been the new narratives. I don't feel like we've had a lot of things. It's been almost 5 years that we've had these constant focuses around themes, right? Like even before COVID, we had it with electric vehicle things and cannabis and stuff like that. And then during COVID, we had the COVID benefit versus the COVID you're harmed by it things. I mean, that was remarkable looking at like, I think it was Zoom is the stock price is above where it was when it first happened. No, it's pretty close to, I mean, it's close to what it would have been right before. I think maybe it's doubled or something from like right before COVID, but it's probably not much higher than what it was within a month or so of COVID.
Yeah, they're like, we're right where basically it was.
Pfizer, I think, is
2019.
down since COVID, even though it had COVID vaccine. That was a great thing for the world, but it was not a great thing for the company's stock long term, as opposed to if they'd been working on weight loss drugs and stuff instead of COVID.
Mm-hmm. Do you have any, Dr. Geoff, do you have any thoughts on these weight loss drugs? Ozempic,
Yeah, I mean, Mounjaro? I know some people.
There's someone. Yeah, I will say there's someone very close to me taking Mounjaro, and started in July, beginning of July, and completely changed his life though, and eating habits, and exercising, walking, down over 100 pounds.
Yeah, that's
over 100 pounds since July.
That's amazing. Yeah. That's amazing. Now how it works.
What are the long-term effects of that? I don't know, but yeah, I mean, I'm happy. I mean, completely changed his life and his habits, which is probably the most important part, one of the most important parts, so you don't just gain it back, whatever. But I mean, it is crazy. Did we just cure obesity in the United States? Is obesity gone forever?
It depends on if people are happy with it and with the side effects and stuff, right? And so far, it seems like they are. I mean, we've had drugs before, whether drugs that treat alcoholism, drugs that treat weight loss things. I mean, when I was a child, I didn't have a weight issue, but I was prescribed a drug for, it was a precursor to like ADD type drugs. And I was losing weight as a child. I couldn't keep weight on and stuff. So it's easy to give people drugs that will suppress their appetite to the point that they don't find food appetizing and stuff, but it has horrible side effects. And so obviously you don't want to do that. And these drugs so far have been great that way. And we'll see if people stay on them for a long time. They're also, when they talk about the costs and all that, like people won't companies and governments and stuff won't cover this. I mean, if they have the benefit of actually keeping that weight off, I don't know, the cost benefit looks pretty good. Now, if you do give it to like eventually 50 million people or something, if you look at the incidence of stomach paralysis and stuff, you'll have a lot of cases, because that is a side effect that for every, however many thousand people, there are meaningful cases of that and stuff. So there'll start to be more coverage of some of the really bad outcomes, which is for a really small number of people. But any drug that you give, just same as like a vaccine, 99.9% safe for most drugs is great. But for something that you prescribe to tens of millions of people, you'll start to hear news stories about terrible cases, because that's still thousands of people that will have bad things happen to them.
Mm-hmm. Yeah, I mean, and from the paying standpoint, I think he pays even with insurance or whatever. He still has to pay out of pocket. I mean, over $1,000 a month. But then you look at like what that costs in Europe and other parts of the country, and it's or other parts of the world, it's like nothing, like $200.
Yeah, and paying $1,000 a month to permanently take off that much weight and keep it off is a pretty good deal for the person and for anyone else who's exposed to their health liabilities long term. You know,
Yeah.
I mean, it's not
Hmm.
good if you're doing it to like get an acting job because you want to be 20% underweight or something, what the healthiest thing would be. But for people who are obese, it's actually a pretty good cost benefit trade off, even if the drug's pretty expensive, you know?
Yeah. Hmm. Yeah, it's crazy. Crazy. So, yeah, I mean, and to your point about like CPG companies being concerned, who was
Yeah.
it? Can't remember, but I did see one company that was like, "No, we think it's great because that means people will be willing to eat these foods more because they're not going to gain weight, or they'll eat more of our food, our crappy food on the shelf, because they have this drug." They're acting like they're not scared, but I definitely think they're probably worried about it.
Yeah. Um, I don't know how much it'll affect those things, because it's complicated, but the profitability of it isn't necessarily as affected as much as you might think by the total amount that people are consuming. So there may be ways to go up market with some things. If people are consuming very little of stuff, they may spend more on it. I don't think that's usually the key constraint for something. I know that's always what people focus on, is the total addressable market, like how many pounds of this thing are people going to eat or something. But it's more like, for these food companies, what's the pressure in terms of negotiating power with the stores, and how strong their brand is, and whether they can charge a good price for it and everything. It's not just, if people are willing to eat lots of junk versus not, do we make a lot of money? There's not that much seeds that gets consumed, but it's extremely profitable. Whereas you can go look at Bridgeford Foods or something and see that they probably sell a lot more stuff than See's does by pounds, but they're not some amazing business because of it. So, yeah, but they got to figure things out. But so I think this is more short term. People are like, oh, they'll be destocking of this and everything, and it's a way to play it this year or something in the stocks. That's kind of how strategists think about it. Yeah, but
Sure.
yeah,
One thing that's been super surprising. I don't want to say surprising, but just definitely, I think something that's very true. An individual stock idea could be very powerful from like a return perspective, but a theme, I
yeah,
think, has to be more powerful by like a multiple of like three, four, five times than an individual idea. And I think that's really because the flows of Wall Street and people getting behind it and chasing what's working or what's working recently, and just the way that market dynamics are set up. Like because of um, multi managers and all of these different funds, these huge capital flows that really just chase what is working, and they're so concerned about next quarter and guessing
mm,
next quarter and just how momentum and everything works in today's markets with computers. Themes can be pretty powerful from a stock return perspective. Now you gotta, I guess, you run into the issue of when to hop off that theme or whatever. It's a totally different investing style, but I've just been consistently surprised at whether it was Bitcoin, AI,
yeah.
whatever, how strong these moves can literally be. And it's like all rationality, everything, you could just throw it out the window. The only thing that matters is just prices going higher.
Yeah, I mean, so much of the returns and things are the multiple expansion and contraction. And I think what we've seen the last 5 years, something like I was saying with these different fads or whatever, it's more than like the growth thing that we saw in 2000. And it's more momentum is the thing that's really different. That's the part of this that feels similar to 20 some years ago, is that there's a momentum aspect to it, and people do get trained to go with the things that have that momentum. And then, of course, you have to get out of them, because some of the ones that we talked about have really collapsed in terms of their stock performance, But then there's something else that comes out that gets people's attention to it. So I think that's the thing that's been different. That's really, especially for retail, right? I think they're very attracted to themes and momentum.
Mm-hmm. It's interesting too, talking about like just a little segue here, but talking about like foods and CPG companies and the shelf life. I mean, at our house, we make bread, homemade
Hmm.
sourdough bread, and have it pretty much every night. I would say by day 2 or day 3, there's mold showing up
Yes.
on it. Like it's just not good. You have to throw it
Hmm.
away. So it is interesting to think about like how long Wonder Bread, all this other breads that you get off the shelves at supermarkets, how many preservatives and all this other crap that isn't natural or whatever is injected in there to keep these things from being edible for 2-3 weeks or whatever it is. I mean, what is the
Yeah.
average shelf life of, I mean, a Twinkie, we've spoken about that before, but like, what
Yeah.
is the average shelf life of like bread, that a loaf of bread that sits on the shelf?
Oh, that's a good question. So, I mean, bread is only good, historically, bread was only good for 1 to 2 days. You use day old bread for something else, then you did the first one, and it was 2 days, and that was it. Um, yeah, I mean, it's very long for the breads that we were talking about. It can sit on a shelf certainly for a week, then be bought and sit for another week without any problems. It can also be stored differently. You can keep it in plastic wrap and stuff like that, which is not a way you could ever store bread. I mean, with a bread box, you could last a little bit longer than what you just said. Like you could add a day or two to it if you, at least the parts that aren't exposed. Um, yeah. So, I mean, there's a lot of things that are added to it, but that's why, your grandparents or whatever thought that canned things and all these preservatives and stuff were great because you
Yeah.
couldn't have stuff before. Remember that most people in a lot of parts of the country couldn't have fresh bread or any of that.
Mm-hmm.
Their diets were completely different because they couldn't have it, and they worried about food safety. One thing about
Sure.
processed everything is that it's completely safe and you don't get sick from it. I remember someone was visiting me from another country. They had not been to the United States before. And we had some like fruit out there, and they were like, "Oh, can you eat it? Like, you can just eat the grape with the skin and stuff after you've washed it." And I said, "Yeah, it's okay," because in their country they spray pesticides on it that would make you very, very ill.
Mm-hmm.
And so, you know, that it's a trade off that way. Obviously, we don't worry about those food safety things in this country because of that. But that means that your food doesn't really reflect very natural stuff at all.
Mm-hmm. Do you think that has a correlation to like being bad for us? If you had to put the tinfoil hat on?
Eh.
I mean, have you
I
seen
mean,
pictures of, I mean, you see pictures of, like the beach, people on the beach. And of course they're cherry picking this, but I do really wonder, right? Like the beach in like the 1950s, 1960s, people are,
oh,
slim, fit, whatever, versus like
yes.
today.
Oh,
And
it
it's
makes
like
people fat.
different.
Yeah. No, of course. Food is much more appealing now than it ever was before because you can add all these artificial flavors to it. You can change the texture. You can do everything to make it very, very appealing. And there's also a societal change in which there's much greater acceptance of not being slim and stuff. So, I mean, there was a huge stigma with being fat in the periods that you're talking about in like 1950s or something, right? So that's also a difference. But yes, so if you mean getting fat and all of that, yes. Some of the other things are pushing it a little far, like, I mean, I've mentioned before ancient things. We have ancient sources on some things. There's some ancient people who ate only the healthiest, most wonderful things that you could ever imagine. The Egyptians, for instance. And we know some of them died of heart disease. So, unfortunately for people, it's quite genetic, and you can eat, chickpeas and whatever, and a vegan diet, and you can still die of it. So, that part is sad for people that there's not a one-to-one correlation for the entire society that we're talking about. Yeah. But in terms of each individual outcome, a huge part of it's genetics,
Yeah.
throughout all
No,
of history.
100%.
Yeah.
Yeah. I think
Yeah.
I've thought about, I'm like, it's got to be like 90% of it is genetics. Yeah.
Yeah. So, I mean, if people are selling you that you could just eat, this perfectly healthy diet, and that will definitely mean that you're not at risk for some different things. No. But if your entire society switches to eating these things, yes, absolutely. No, I'll be, but, until 200 years ago, well, a little less than that in most countries, I mean, everyone was malnourished. Only
Mm-hmm.
about 200 years ago, some Nordic countries, the United States and stuff, do people reach heights that are similar to now because there was the first time that the entire population wasn't malnourished. So, there are trade offs. You have extremely cheap, extremely flavorful, and extremely safe food as a result of all this processed stuff. So,
Mm-hmm.
yeah, there's very bad trade offs to that, but you also don't have people that go hungry or that have, contaminated foods of different kinds and stuff. So,
Mm-hmm.
I mean, it's the same as like, buying IKEA furniture and putting together yourself and stuff. Is that as good as the furniture that they made custom for people and stuff? No, it's not, but everyone can afford it now.
Yeah.
So,
Uh-huh.
and no one could before, you know?
It's like we should turn this into a Joe Rogan style podcast. Geoff, how were the pyramids built?
Yeah.
um, okay, let's see. Let's get back on track. The Mag 7 stocks add more than 200 billion of market value in a single day.
Mm-hmm.
Number 36, U.S. aggregate bonds post their best monthly return since 1985. Gold closes at an all-time high. That's an interesting one.
Mm-hmm.
Why is gold rallying? Is that because of being worried about the fiscal situation with the United States, the debt,
Right.
the rating going down? That's something that I think not a lot of people have been talking about, but that has caught my eye.
Yeah. So there is one kind of worrying aspect to that, I guess. If
Is it
the market's
Costco selling gold?
Costco is selling gold, yeah. If the
Gold
market's as
bars?
efficient as people say, theoretically the price of gold, it's quoted in dollars, so you know it should go up and down over time with the total amount of dollars out there, basically, relative to the amount of gold. But other than that, what should be affecting is real interest rates. So gold has a cost to carry it, to hold it, which is that you're giving up the real interest rate, and then there's an added cost with gold if you actually hold physical gold and stuff. That there's some cost, or if you hold it through a fund, there's some administrative costs and stuff. So that's fine. But gold is inert, so it should relate to real interest rates. So when real interest rates are high, theoretically something like gold should be low, and when real interest rates are low, gold should be high. The one interesting thing about this is the reaction in gold does suggest that what you're seeing with the Fed's predictions for the future is a decrease in real interest rates, which I think is not what the Fed is saying. What they're saying, really implied in the dot plot and stuff, is that they're lowering interest rates in the future. They're expecting to simply to keep it in line with the reduction you're going to see in inflation, right? So they don't think that they're lowering real interest rates. That's what they've mostly said is like, well, if inflation comes down, we have to lower interest rates because otherwise we'd be raising real interest rates. Theoretically, very high real interest rates are bad for gold. I mean, that's like, if you just think about it intellectually and stuff, that's what the relationship should be, is if you think of a lot of money is going to be printed and you think that real interest rates are going to be low, that's good. And if you think not a lot of money is going to be printed and real interest rates are going to be high, that's bad. You know, the Fed focuses on this a lot. It's real interest rates that matter. Just because at some time in the 80s or something, interest rates were at 15% or something. Well, if inflation's at 15%, interest rates could still be not high enough. So that's a big debate about what's predicted in the next year and stuff. Is this just lowering rates because inflation's coming down and so they have to do it to keep real rates the same? Or is this actually loosening? Because only a real rate decrease is loosening. So if inflation comes down and they don't lower rates, that's tightening in their view. And so we should keep that in mind. Everyone says that they're loosening, but if they don't intend to cut faster than inflation comes down, then that's not really loosening. That's just keeping it at the same rate that it is now. Yeah.
Well said. 38, they had, I guess, toot their own horn. JP Morgan Private Bank releases its outlook titled After the Rate Reset, Investing Reconfigured. That was a major event in their eyes for 2023. Okay.
Yep, right up there with
39. Yep. Okay. Let's see. COP28 climate talks end with a call to transition away from fossil fuels.
Mm-hmm.
And then 40, the Federal Reserve signals rate hikes are over and cuts are on the cards. So major events in 2023. So, yeah, I don't know. Any thoughts on major events in your eyes? How will you remember 2023, if at all, as it relates to markets? Yeah. What are your thoughts? Any predictions for 2024? Anything that we could look back at a year from now and see what we got right and got wrong?
Yeah. I think it'll be remembered for rates the same way as before. Now, you know, it's been a few years where people have all been worried about rates, but COVID has become less of an issue that people are worried about. You know, things have reopened and all of that. And so that's just like, it's sort of lapped those things. And so people aren't talking about that and the return to work and all that kind of stuff, the return to office and all that kind of stuff. So it's been really focused on rates and the financial parts of it now, I think, more than the business aspects of what happened during COVID. So I think that's the main thing. And I think 2023 will probably be remembered for what happens in 2024. If it turned out that they were right in 2023 or wrong, you know, this will be remembered more as like, you know, Did the Fed make a big mistake? Did the Fed have a perfect landing? What did they do wrong? What did they do right? That kind of thing. Because this is a big pivot, right?
Yeah. Mm-hmm.
So it's the first big pivot that we've seen in a while. I mean, it's basically 2 years or something that they were following a path. So
Mm-hmm. And what odds would you give towards over tightening, acting too soon? Yeah.
um so let's see. I guess I saw some polling on this which said that the chance of a no landing, the people who said the most likely outcome was a no landing or something, was at like 5%. So they basically have it as like almost 60% or something that'll be a soft landing, and the rest of that percentage being that it will be a that you'll have a recession. There's not much serious consideration of the no landing scenario with inflation, and so I would put the odds of the no landing thing much higher than other people are. That's not the odds. They're saying what's the most likely. They probably would put the odds higher. So that doesn't mean that that's what we'll get, but I think that's probably much higher than people think. They seem to have a healthy respect for the idea that there could still be a recession, but not such a healthy respect for the idea that there could be inadequate tightening, that, if something could happen that could cause inflation to go up again. But that wouldn't be immediate, and certainly you wouldn't realize it immediately. Um, but it could happen if you obviously cut rates too much. Because what would happen is if the Fed cuts rates as if they think inflation is coming down, inflation doesn't come down, what we just talked about would happen, which is that you have very insufficient real rates, right? So if you say, okay, we're bringing rates down, like we expect inflation to go down 1.5% or something over the same period, and say it goes up 1.5%, you've just actually cut rates by way more than you should have because you went in the wrong direction that way in terms of real rates, and people will feel that. So, but the same is true if they like don't cut fast enough to match inflation. They have to kind of, things could feel the same way that they do now if they're very good at matching off the declines in inflation with rate cuts. But if they don't match them very well, then you're either going to feel a lot tighter or a lot looser than they intend.
Do you have any interesting stock predictions or anything? I mean, similar, you gave us Green Brick Partners, Vera Bradley, anything that you think, irrespective of markets, that looks pretty stupid cheap right now and could work out?
I'm not sure I know anything that looks stupid cheap, to be honest, right now.
Yeah.
It's a lot less. There's a lot less in the bargain bin at this time than there was a year ago. And I think that's probably because of the lack of concern about a recession as compared to last year.
Mm-hmm.
So last year, you could be wrong if you bought Vera Bradley and then it just completely collapsed there, right? Like, and Green Brick, discretionary spending and everything collapsed. Discretionary spending, consumer discretionary was really cheap a year ago, as compared to like more stable consumer staple stuff. And that's not the case anymore. So, it's easier when people go kind of too far in one direction, betting against that. Magnificent Seven shorting that probably is more of like that bet this time. So if last time it was what is definitely too underpriced, what's in the bargain bin, what are people not considering is that there might not be a really bad recession in the next year or something. Probably what people are not considering is that those 7 leading stocks will do worse than the overall market and will do badly in absolute terms. That there's too much consensus on that and stuff. That would probably be it. Not all of them are super expensive, like, but some of them are. And there are some stocks that are crazy expensive. We've mentioned FICO on this before and stuff, because that was a stock that I owned, a decade ago. Some of those things are to really remarkable price levels and stuff. If we get a beautiful soft landing with the rates coming down, I mean, I can tell you some things that would benefit. I mean, we've talked about Carmart before. Carmart is the biggest beneficiary of a beautiful soft landing. Right now, it has charge-offs that are very high, and it has deposit rates. It has short-term borrowing rates for it that are very high. It's funding rates for itself. It's not a bank. It doesn't take in deposits. But that combination is really, really bad for it. So if you were sure of a soft landing, then I guess you would like something like Carmart. However, the reason why I caution on that is the soft landing is the middle outcome, right? Like threading the needle. If you miss in either direction with Carmart, things can be bad. If it turns out there's a recession and rates go to nothing, right? Like we talked about Hingham, right? So if rates go to nothing, they could have charge-offs with credit stuff, sure. I mean, it will be bad compared to their normal outcome of like no charge-offs, right? But they don't have a lot of credit risk. So a recession with rates going down to like zero instantly is good for them. Carmart, if rates go down to zero instantly, it's probably because a lot of people are defaulting on their car loans and being repossessed and stuff. So there's not a lot of outcomes where you imagine that goes to nothing. So, but if you're sure that there's going to be a soft landing, then I think something like Carmart is one of the best examples of what would be a soft landing bet. But the stock can be hurt by missing in either direction. If it turns out that things change and rates go up even higher, within a year of now, we're hearing predictions that rates will have to actually be raised at some point. That would be really bad for them. And the same thing.
That'd be bad for the market. That's not probably being priced in at all.
No, and the same thing if there's recession for them because they take serious credit risk, it would be bad. But if you're sure there's going to be a perfect landing, then that kind of subprime credit stuff where you borrow short, lend a bit longer, they lend 40 months or something on average to really subprime customers. That's the ultimate bet on a soft landing is a short term money funded subprime lending business like that. That's the one. Whereas like the bank that we mentioned before, Hingham, a perfect soft landing is not so great for them because theoretically a perfectly soft landing involves the longest inversion of the yield curve, because normally the yield curve on inverts at the moment that you go into recession. Basically, that's actually the ultimate signal of the recession is the on inversion. If you just think that you're about to have a recession but you never have it, then that's actually how you get the longest inversion. And so that's why I mentioned that with something like Hingham versus something like Frost. Something like Frost, people are if rates come down as fast as they're saying, then that's not that's not terrific. It's not that big a deal. I mean, they're much less sensitive to rates and stuff when rates are this high versus when they're near zero. So rates going from 5 to 4 or something doesn't affect them the way that they go from 0 to 1. They disclose that stuff in the 10K. So they're pretty neutral at like 5%. If rates go to 4, if rates go to 6, for a lot of banks that won't make a difference. But if rates go to 0, it makes a huge difference, right? Or if rates go to some very high number. So yeah, I'd say probably. If you had to pick the thing that's probably overvalued or overdone, it's that Magnificent Seven thing that we talked about. That's probably it, is short the Magnificent Seven as the thing that is most overdone with people. U.S. stocks, big stocks, most popular stocks. We didn't talk about it, but the actual median stock return for much of this year hasn't been that great. Like if you're looking at your own portfolio, there's probably close to as much red as green in it. But if you own indexes, there's a lot more green.
Yeah, I said if you use the RSP, which is the equally weighted S&P 500, it's up 10% year to date versus the market, the SPX, which is driven mainly by Mag 7 being up 24%.
Yeah, and if you get a super boom, if that really happens, that you get a beautiful economic outcome, usually that does benefit companies that are very small more than it benefits companies that are very big. I mean, the high short-term interest rates are more of a pain for very small companies than they are for very big. Apple doesn't have to worry about talking to their bank to fund inventory for the next year and stuff. But when we talk about things like, we mentioned Jewett Cameron or something, like companies like that, though cheap and everything, are extended to a point that would concern a bank. They funded a lot of their inventory and stuff. And even though Dollar General did the same thing, or Walmart did the same thing at some point, no one is breathing down their necks that they're in real trouble that way. But a micro cap that draws all of its credit to build up inventory, they do have people breathing down their necks when it's a tight credit environment, and they don't when it's a loose one. Yeah. So I can't think of anything else. What do you have that way in terms of what things might be way overdone?
So it's interesting. I do think Mag 7 is overdone. However, I've been doing this, paying attention long enough to understand how things could be. Like, I have this theory. I mean, and I read it in a book once, actually by the Santa Monica Partners guy, and he had said that he believes that the market's going to do whatever it has to do to make the most amount of people wrong.
Mm-hmm.
And I think there's a lot of people saying that Mag 7 is overvalued, and I just think it could continue going on. But it's kind of in that bucket of I wouldn't short it, I wouldn't buy it, I just wouldn't do anything. I would just kind of stay away from it. It is interesting, though. Like, you look at the equally weighted SP, and it's only up 10%. And the rest of, the actual S&P 500 is up 24%. I don't know. It is bizarre. I think it seems pretty unhealthy, but I think rates will come down. It is an election year. So who knows, this time next year, who knows what we'll be talking about. We'll have a new president by that point, right? And
Or
I think it's going to be a pretty crazy year.
They are running for re-election.
Correct. Or you could have the same president. Yeah. So
you'll have a new election.
Yeah. So I think it's going to, do you think it's almost orchestrated for rates to come down? I don't want to get into politics here, but do you think that was sort of intentional because of the debt, how much we have to pay on that? Like, this was all this was all planned. Like, this was they knew they were going to raise it really hard and then, cut really hard into an election year. No. Okay.
No. Oh, no. I do believe that. I don't know in the minutes and stuff if they'll disclose that and tell that. But yes, I am sure that the Fed, the FOMC, does understand that they themselves may be more reluctant to raise rates going into an election. What has been the biggest problem for the Fed historically, in terms of their independence, has been attacks on them, personal attacks, sometimes delivered in person. Truman did, Johnson did, not to raise rates going into an election. I'm sure that George Herbert Walker Bush thought that he lost the election because of Fed policy and stuff, for instance. So that is a big issue that they would know, that even though they would say publicly we'll raise rates, I don't think you would raise rates 75 basis points at a time headed right into the election unless you really, really had to. So they would probably prefer to get to that level just prior to the kickoff of the campaign, really, than to have to be doing it during it, because otherwise they know people will be tweeting about them or Xing about them. I don't know what the verb is for that. And, talking about them and everything. And they'll be getting letters from senators and, all that stuff. They'll be invited to the White House to sit down and chat about those things. So I'm sure that they would want to avoid those kinds of things. Yeah, no one's going to say, I think the Fed, no candidates are going to say, I think the Fed should raise rates during the campaign. So some might say, oh, the Fed is independent and I wouldn't tell them what to do and stuff. I think less of that now than there used to be. I think from about Reagan through Obama, that the Fed was lucky that way, that there was a general consensus just to let the Fed do its thing. And there isn't now. So there'll be some people telling them that they need to cut rates. And certainly they won't be anyone telling them that they need to raise rates. But the other point that you brought up was the ability of the government long-term to fund itself with, the interest costs on top of the primary deficit. And we covered that in an earlier podcast. It's not sustainable, so they got to address it somehow. And neither party seems that interested in doing anything about it. So that's the big shift of why you don't have a AAA U.S. credit rating and stuff anymore. I don't have any other long ideas. I do, similar to the Magnificent Seven one. I guess there is one other one which I would say is probably somewhat underappreciated right now. Electric cars. It will not be a good year for electric cars next year. They are oversupplied and they're continuing to oversupply themselves. And it hasn't caught on with the general public in the United States or the UK. I mean, we saw an earnings report from Virtu and stuff that specifically singled out electric cars as a problem. And so their companies are concerned. They're pulling back on production things and everything that are clear that they know they're going to oversupply them and they might have to discount them and everything. I think that's something where rates really showed people that that's a discretionary purchase. That if rates could be at zero or something, then people would be a lot more likely to like that. And the presence of so many more used electric cars in the market with the rates really does cause a bit of a problem. So I have no idea if the stocks could go up while the earnings go down. But, my thing is usually look at the inventories and everything to predict what next year is going to be. And I would say not a good year for electric cars. That could really surprise people in terms of how bad it is. Oh, and we can also predict something, which I think is pretty sure, which is that box office will be lousy next year.
Yeah.
Supply. Again, it's a supply driven thing, so it's easy to see. I think 20% down in terms of supply. Now, I think the box office probably won't actually be down 20% in terms of dollars and stuff, because you're going to see Boy and the Heron did well, Godzilla -1 did well, the concert films did well, Sound of Freedom did well. There's just going to be so much more stuff to put in there that isn't on the studio slates. But the slate that we've got from the big studios is abysmal. It is really, really, really bad. Some of that's driven by the strike. Some of it's driven by hangover from the streaming stuff, where they put stuff on streaming instead of doing it for this. But no doubt you're going to have a terrible supply of movies from the big studios in the next year. And absent, it's not a lack of demand, but it's going to be an undersupplied market. There's going to be more demand for people wanting to go out to the movies than are going to have things that when you look up and what's playing in my local movie theater, something I've actually heard of or know about, it's not going to look good. Yeah. That doesn't mean the stocks are bad, though, because some of these stocks haven't recovered much and are pretty cheap, obviously.
I think Marcus is very cheap. We don't own it, but Marcus Corp, I think it's pretty cheap. And they also have exposure to real estate stuff.
I've been amazed by how well the hotel business there for Marcus has held up. Yeah. That's something that I would have thought that the movie business would have come back more.
I was going to bring this up to you recently, but here we are doing it on the podcast. Being like, because just anyway, you kind of you run the numbers. It looks pretty cheap. You do know that 2024 will probably be a bad year for movie theaters, but you look out on a 3-year basis, it's probably trading very cheap.
Yeah, but that is one that I want to put out to people, because that's the kind of thing. The electric vehicle one, I think, is getting into the news and stuff now, but it's something you can see. And I think the theater one is something people could overlook, because they're going to be like, oh, well, demand must be back even more because everyone's going to want to go back. The COVID stuff, I mean, that's well in the past now. And yeah, but it's demand and it's supply. And I think everyone in Hollywood knows it looks awful. And I think that the theaters and stuff know that and say politely in the earnings calls about that. What they say basically is, well, we're going to try to improve our metrics, even if we have, on a per thing basis and stuff. Like, maybe we can keep our earnings flat or whatever, even though the market's going to be bad. But they know they're swimming against the tide next year. And I don't know that everyone knows that we can see what's coming next year, and it's not good. So, that's like in these stocks, that's something that people should be aware of. Some other people in the stocks know that, and you might not know that. So it's a good thing to mention, the same as the electric vehicle thing, that, look, the stocks could do great or not, but I think there's going to be a glut of electric vehicles next year. There's going to be more vehicles out there than people wanting to buy them. And I think there's going to be more people wanting to see movies than there are going to be movies to sate their appetite, basically. So what predictions do you have for 2024 this time?
I don't have any predictions. None? I don't have any predictions. None. No. I think value's coming back. I'm going to die on this hill again.
Is the market going to be up or down, though?
You know what's crazy? It's just like, I'm like, markets only go up. Stocks only go up. Nothing else matters.
I think there's a much higher chance of the market being down next year than there was this year.
Really?
Is my guess, yeah. It's all against sentiment and stuff, right? Like, what are people seeing for the next year versus that? Last year, people were gloomy, as compared to this year. People are really, really optimistic, considering. I mean, we are recording this at a time where, like, 9 of the last 10 days or something, the market's up. I don't know if it's exactly that, but something incredible.
The S&P 500 chart looks insane. It's just like a gap up and just boom every day. Boom every day.
And that's even been days where, like, there's been some Fed people who said, oh, that was quite a move up. I mean, we didn't say that much about lowering rates, and they're excited about it, So even on things that sometimes would get somewhat of a reaction, that the Fed is saying, like, oh, let's backpedal a little bit on that. We didn't mean to go quite that far. The market doesn't get concerned. Whereas, like, a year or two ago, I think the market would be concerned if there was any hint that they said, well, the market kind of overreacted a little there. Yeah. So there's a lot baked in. is all I'm going to say. There's a lot baked in. When you're counting on rate cuts, as opposed, last time they were counting on rate increases. They were saying there will be increases. Basically, we still know that's going to happen. Now they're saying they baked in the rate cuts.
Big difference.
Big difference. Yeah. So don't know, can't predict, but I would say the odds are this year for the overall market, 2024 versus 2023, it could be a lot choppier because you're just coming in with much higher expectations. Charlie Munger would always say, the importance of low expectations. Well, that's really important to market. That fixes everything. That's why we mentioned Vera Bradley last time. Not that anything good would happen, but the expectations were so low. Here, the expectations are pretty high. They're expecting a soft landing, and it's soft landings don't normally happen. So they're expecting a really good outcome.
Mm-hmm. Mm-hmm. Got it. Cool. Well, this is the last podcast of 2023. So I want to thank everybody so much for constantly tuning in with us. It's been an interesting year. And I'll be one of those guys that says that on like New Year's Eve, see you next year, right? See you guys next year. Well, I want to thank everybody so much for tuning in with Geoff and I. Be sure to hit the subscribe button wherever you're listening or watching us. We will review this podcast in 2024 at the end of it, probably about 1 year from today. So I want to thank everybody so much for tuning in. Hopefully you have a great holiday season, and we will see you in the next podcast. Take care.